It is difficult to determine the best investment in the stock market since 2019 as it depends on an individual's investment strategy and risk tolerance. However, some of the top-performing stocks in the S&P 500 index since 2019 include technology companies such as Tesla, Amazon, and Apple. Additionally, companies in the healthcare and e-commerce sectors have also seen significant growth. It is important to note that past performance is not indicative of future results, and individual research and consultation with a financial advisor is always recommended before making any investment decisions. Additionally, it is worth noting that the stock market has been significantly impacted by the COVID-19 pandemic, which began in late 2019. Many industries have been affected by the pandemic, with some companies experiencing significant losses while others have seen significant gains. For example, companies in the travel and hospitality sectors have been hit hard, while companies in the technology and e-commerce sectors have seen a surge in demand. It's also worth mentioning that one of the sectors that has been most affected by the pandemic is the energy sector. The oil price crisis that started in early 2020 has hit the energy sector hard, causing many oil and gas companies to struggle. Overall, it is important to keep in mind that the stock market can be highly volatile and past performance is not necessarily indicative of future results. It's always recommended to conduct thorough research and consult with a financial advisor before making any investment decisions. Whether growth stocks or dividend stocks are better depends on an individual's investment goals and risk tolerance. Growth stocks are shares of companies that are expected to experience high growth in earnings and revenue in the future. These companies typically reinvest their earnings back into the business to fuel growth, rather than paying out dividends to shareholders. As a result, growth stocks tend to be riskier but have the potential for higher returns over the long term. Dividend stocks, on the other hand, are shares of companies that pay out a portion of their earnings to shareholders in the form of dividends. These companies may not have as high of a growth potential as growth stocks, but they can provide a steady stream of income for investors. Dividend stocks are considered less risky than growth stocks because they provide a consistent return, which can be useful for those who are nearing or are in retirement. It's worth noting that a well-diversified portfolio of both growth and dividend stocks can provide a balance of potential returns and stability. It's also important to consult with a financial advisor before making any investment decisions. Additionally, it is important to keep in mind that dividend stocks can be a good source of income, but their dividends can also be affected by the financial performance of the company. Dividend payments can be cut or eliminated if a company is not performing well financially. In contrast, growth stocks can be seen as a way to participate in the long-term growth of a company, but their value is highly dependent on the company's future prospects. Another point to consider is that some investors may prefer growth stocks because they have the potential for capital appreciation, which can provide a higher return on investment than dividends alone. On the other hand, some investors may prefer dividend stocks because they provide a steady stream of income, which can be useful for those who are nearing or are in retirement and need a regular source of cash flow. In short, the choice between growth stocks and dividend stocks depends on an individual's investment goals and risk tolerance. It's always recommended to conduct thorough research and consult with a financial advisor before making any investment decisions. Thank you for watching this video. Please hit like and subscribe for more investing ideas and updates.